Hey traders, this is Ron Haidt at Market Tamer. Happy Sunday. Hope you're having a great day. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. Kick off here with the SPY, new all-time highs, closing practically at the highs of the day. Bulls are in charge despite the typical summer doldrums. I would look to the red line, the 20-day exponential moving average, as a sign that the trend is changing. As long as we stay above it, the 20-day period, which is essentially a month's worth of data, it's bullish. Take a look at the diamonds via the DIA, the Dow, closed at the highs, new all-time highs, bulls, bulls, bulls have the edge. Looking at the Qs, they didn't have quite as good a day, but still finished at new all-time highs, and the IWM continues to lag. Let me zoom out actually a little bit. Here we go. You can see this downtrending channel. Now if I zoom in, it's weird, but we're back testing it. It's a little odd. Back test, back test, back test, back test. We're staying above the 20-day. As long as we stay above the 20-day, the bulls get the overall edge here. This is a little bull flag. There's the flag. There's the flagpole. But if I had to pick one of those four index ETFs to trade, spiders, diamond Qs, or IWM, everybody but IWM is performing very, very well right now. So maybe it decides to play catch up at some point, but we would need to take out that high from May around 160. Then maybe it gets more of a technical edge and might try to play catch up. Right now, it's also just in a horizontal trading range. So nothing exciting on IWM. I think there's better fish out there to look at. Earnings season is in full swing this week. If I bring in a picture of the CBOE, you can see this is just their version of earnings. There's 11 on Monday, 32 Tuesday, 58, 70, and July 19th is also monthly expirations. There's going to be a lot of fireworks this week. On Wednesday in particular, IWM reports, so does Alcoa and some others. But if you go to profit charts here in Thinkorswim, it says 717, 4 p.m., which is basically at the market close. If you go back through history on IBM, you can see there's lots of gaps, lots of big moves, right? Up and down. Some can be really, really awful. In the case of IBM, if I had shares of IBM, I would be looking to protect that value. Here would be an educational example of how I could do that. IBM, there's the stock. Usually 45 to 60 days is plenty, somewhere around 45. If I go to September, I'd be looking for something right near the money. The stock's at 142. Near the money just means a strike price near where the stock is trading. We could call it the closest one. Open interest is this O column right here. There's 1,800 open contracts. That's a ton. I could consider this strike right here. It's $4 by 415. Might be able to get a nickel off that if I put an order in at 410 in a paper trading account. But for every 100 shares, this is the type of option I'd be looking to protect value. If I wanted something with a little more protection, the one higher at strike 145 will have a higher delta. It'll make a little more as the stock starts to drop on a per share basis. But 140, 145 would be good examples of that. And then we can follow up with this one later in the week and see how the stock performs. If the stock jumps higher, put loses value, stock gains value. Stock drops, stock loses value, put gains value. If the stock goes nowhere, that option may not gain any value at all. In fact, it's likely going to lose value is what's going to happen. There'll be implied volatility crush, and we can take a look at that again later in the week. Just a quick review of some of the other most common stocks I get asked about. Apple has earnings towards the end of the month. You can see the dollar sign there at 7.29. It's staying above the red line. Bulls have the edge. Amazon, big Prime Day coming, but they also have earnings. If you look, 7.24, about 10 days from today, they're challenging new all-time highs. Google, they have earnings, 7.22, about 8 days from today. They broke above the 50-day. Their next resistance point is pretty much that gap around 1,200. Don't know if it's going to get there by earnings, but that would be the technical target as of now. Netflix, they have earnings, 7.15. That is tomorrow, according to Thinkorswim. Oops, let me not zoom in here because what I want to show you is anything can happen. The stock could challenge all-time highs. They could miss. There's some support here around 335-ish. If that fails to hold, you're talking about the December lows. It'll be very interesting to see. Now, if I wanted to do a protective put example on Netflix, again, 45 or so days. September is another month that's available. Stocks at 373. I could come in here, for example, and use strike 370. This is going to be expensive, but it's also a $300 stock, $2,000 per 100 shares, 2,040. Delta 0.43, stock drops $1. That's the amount of value that strike price would gain, that long put option would gain. We could do IBM and Netflix as two protected put examples this week. All right, Abercrombie. I brought this one in a couple days ago. It got above the 20-day, and now we're marching higher. The target's going to be the gap down at 20, and look where the 50-day is. That's still $1.90 away, but that would be the target. If we get above there, then we go to the gap fill up around 24.5. And then we'll do a review here of gold and silver really quick. 1-year basis, we're at 1-year highs, but what is interesting here is this move right here. This could be considered a long flagpole, and this is becoming a flag. There's also a pennant building, and pennants usually lead to breakouts. And this isn't perfect, so I'm trying to do this quick here in a video. Well, that really wasn't good, right? You sort of get the idea. There's the pennant, here's the flag, and a breakout to the upside. We'd have to go back to 5 years. It's like, whoa, we're at 5-year highs. Now we have to go 10 years. We're at 10, well, not 10-year highs, but you can see the 2016 high. We're in here. We break out of this pennant. I mean, the bulls already have the edge, but breaking out of the pennant on a daily chart, I would say 150 up to 170 would be the target. Now, if I go back into a daily chart of silver, not SKV, SLV, here would be the flagpole, and this is the flag. So a breakout of this trend line would be interesting. What is noticeable is it held the red line here. We lost it here, but the 50-day held in orange, but we're holding it here. 20-day EMA, the red line is a potential trailing stop. Upside targets, 1450, and then back up here to the double top. But again, with silver lagging so hard, so much, it doesn't add, it takes away from the bullish case for gold, because silver should be running with gold, if not even outperforming. If we look at the silver miners, SIL, mirroring silver's move itself, nice big run here, lower volume pullback, we're holding the red line, also a pennant type formation, but it probably needs to get above 28 or so before it really starts shifting with the bulls. If I wanted to try to trade this one a little more aggressively bullish, what I could consider is, frankly, just a break of that trend line, maybe around 2650. And GDX, the gold miners, they're already starting to break out. On a closing basis, on Wednesday, they broke out to new highs. Here's the flagpole. This is the flag. We're starting to break out. Upside targets for GDX, if I go back 10 years on a monthly basis, it's 30. If I go back 5 years on a weekly basis, again, we cleared 25. That was a marker to watch for. It's 30, 31 again. So monthly and weeklies are all lining up to $30 right now as the target for GDX technically. That is 10+% higher. All right, that is it. So I wish you guys a fantastic week ahead. I'll be back with you in this week's video. Enjoy the rest of the weekend.